One, I think we are live.
Yes. Shall I start, sir?
Yes, please.
Good afternoon, distinguished guest. Our college president, Thiru S. Madappa Chettiar, secretary, Dr. G. Selvanathan, principal, Dr. S. Usharani, director, Thiru R. Panneerselvam, all my department staff, colleagues, our young and energetic resource person, Dr. C. A. Abhishek Murali, and Dr. C. A. Divya Abhishek, and all the participants all over India and abroad. It is a great privilege and honor for me to extend a hearty welcome to all on behalf of SIVT College Chennai for the national level UFDP on Epitome of Tax Saving Tips organized by the Department of Commerce, Self-Finance and IQAC of SIVT College, South India 1-Year Educational Trust owes its birth to the far-sighted vision and vigorous initiative of late Honorable Justice through S.A. Ayyasamy Chettiar. SIVT College of Arts and Science came into being with a site of 28 acres at Gaurivakam, Chennai in July 1966. During the academic year 1992-93, the college started its shift to self-finance wing. The college offers 8 UG programs and 2 PG programs under aided stream, and in the self-finance stream, it offers 10 UG programs and 2 PG programs. The Department of Commerce is the biggest department with 3 sections, providing efficient and quality education in commerce. Since the Department of Commerce, since its inception in the academic year 1999-2000. Highly experienced and dedicated faculties are the strength of the department. I now request our college director, Professor R. Panneerselvam, sir, to deliver his welcome address. Okay. Sir, please.
Hello everyone and welcome to today's session. I first of all thank our college management, our secretary Thiru S. Madappa Chettiar, our college president, secretary Dr. G. Selvanathan sir, and all other committee members to give a wonderful opportunity to organize such a webinar, and welcome all the participants from all over the India. And I welcome our speaker, Dr. C.A. Abhishek Murali and Dr. C.A. Divya Abhishek for the session. I don't want to take much time to welcome all because this session will be the very useful session to all the participants. So I hand over to the session to our speaker. Thank you.
Today, we have with us 2 eminent resource persons who are going to share their views and expertise on tax savings. The first person for the session today is Dr. C. A. Abhishek Murali. Dr. Abhishek Murali is a practicing chartered accountant in Chennai with over 13 years of experience in the area of finance, accounts, and consultancy. He is the All India first rank holder in CIMA strategy examinations, 17th rank in CIMA final examinations, 5th rank in the international taxation examinations. He is also the youngest elected regional council member and secretary of SIRC ICAI. He is an expert in direct taxation, international taxation, litigation and appeals, valuation, due diligence and merger and acquisitions. He has addressed over 300 seminars on direct taxes in the year 2019. He also professionally advises various leading industries, high net worth individuals and professionals. He has also been nominated as a honorary first secretary for the Honorary Consulate of the Republic of Zambia. He has also authored several books like Overview of Companies Act 2013, Income Tax Ready Referencer, and also Taxation of Capital Gains, which is under print. Dr. C. A. Abhishek is an active Rotarian and a founder member of Rotary Club of Madras Next Generation. He has also took lot of initiatives to help underprivileged section of society to create computer awareness and literacy. And his accomplishments are endless. We are very happy to have you, sir. And our second resource person for the day is CA Divya Abhishek. CA Divya Abhishek is a practicing chartered accountant at Chennai who is currently the partner of DSNR and Company. She is also an expert in audit, company law, cross-border transactions, and international taxation. She is the All India 46th rank holder in the CA final examinations and 23rd rank holder in the ICSI examinations and 4th rank in the international taxation examinations. She is the youngest ever president of the Inner Wheel Club of Madras Next Generation. She also holds the position of Secretary of Women Professional Empowerment Forum of India. CA Divya has audited and consulted for listed companies, corporate multinationals, public companies, private companies, and other forms of organizations, including high net worth individuals. She has the distinction of being the first secretary to the Honorary Council of Zambia in South India. She has also been elected as a treasurer for the Federation of Indian Chambers of Commerce and Industry for Women for the year 2019 to 20 and the current year 2020 to 21. She is also a keen women social activist with a passionate professional focus on women empowerment and also campaigns for the upliftment of a girl child. Our Private College Management is so proud to have such a valuable resource person, sir. Welcome. Thank you for that. I now
Thank
hand
you.
over the session to the resource person. Thank you.
Thank you so much, ma'am, for the wonderful introduction.
So, shall we get started, ma'am?
Yes, sir. Yes.
Okay.
Okay, thank you. Thank you. So, let me just quickly share the PPT screen. Yeah. So I'd like to thank the college for giving us the opportunity to come and address at this very, very prestigious forum. And we've got a very large gathering of viewers. So it's a very important topic. In fact, I'm happy to say this topic was selected by the college itself. And while we were discussing what topic to select, while I was suggesting capital gains, the college said, I think epitome of tax planning is a better topic. I think this will reach to a audience much better. So we said, okay, it is your choice, ma'am, whatever you say. So I have to thank the college for selecting this topic and renaming the title also. So without further ado, we'll jump into the session. We are splitting it into two parts. The first part will be covered by CA Divya, and I'll be covering the second part. And then after that, we can have question and answers. I feel we've addressed in several colleges so far, and what we found is the question and answers discussion seems to generate much more positive interest, and we are also learning in the process of question and answers. So we'll keep our presentation brief. We'll have more discussions in terms of question and answer session. So any of you have any doubts or you have any questions to ask, you can feel free to type it in the chat window. We will flash it on the screen, like how you can see now. We will just flash one for an example to show what it looks like. So you can see this is how the questions will be flashed. So for the benefit of all, everybody can see the questions also. And you can type it out. Probably midway through the presentation onwards, you can share the question and answers and we will flash it on the screen. So now I'm handing over the session to CA Divya Abhishek, after which I will take over.
A very good afternoon to all of you. As Abhishek had said, we'll be covering tools that you can use to plan your taxation. It's more relevant now because, as you're aware, your due date for filing your return of income for the last year is going to come up. For the current year, you need to start planning ahead of time, knowing that we're in times of recession and so many things have changed. So it's important that you are aware of what are these tools that you can use, how as an individual, without having to become an expert at it, what you can do sitting out of your home to plan your taxes and improve your overall savings. Having said that, let me first give you a brief of how income tax works. As you see, those buckets that I've put in the slide, they are the bedrock of taxation in India. Effectively, any income that you will be earning during the year will fall into one of these buckets. What are they? The first is your income from salaries. This is fairly common because it is something that's going to be applicable to most of us. Whenever we are employed, we are going to be earning salary from the employer that gets taxed under this head. You have income from house property, where if you own a house, say you're living yourself in the house or you're letting it out to somebody for rent, then that will come under this. If you're running your own business, then all of that will come under business or profession. If you're selling a property, you're selling the house you bought, or you're selling equity shares, you're selling your investments, comes under capital gains. The last clause, they also call this as a dustbin clause. That is, it's a residuary clause where whatever income that does not fall in the other four clauses will automatically come under this clause. Now, going by experience, what Abhishek and I felt was salaries, house property, and capital gains is something that is very commonly applicable to everybody. Of course, income from other sources to some extent, where if you have deposits, you'll have interest on the fixed deposits. If you're giving gift, that will also be applicable. So, during our session today, we are going to have a primal focus on these three headings as to how you can crucially plan and save your taxes. We might not get into complete detail of what each heading is. If any of you want to refer it, you can always subscribe to our channel, and we have given more descriptive sessions on each of these heads. With that, let's get into salary. As I already told you, effectively, when you're with an employer under a contract of employment, any amount that you have to receive or which you're due to receive will get taxed under salary. I'll just touch upon this definition for a minute. When I say due to receive, what it means is even though your salary has actually not come into your bank account, by very fact that you've rendered that employment, the amount whether you receive or not, say in a period of lockdown, your employer is going to tell you, listen, I have some financial crunch, I'll definitely pay you. What I will do is March salary, I'll pay you when the lockdown opens up. For whatever reason, say lockdown is opening up in October, at such point in time, you're going to receive salary for March. Now, even though you receive your salary much later on, the very fact that you have rendered employment in March, you will still have to pay tax on that salary. So, whether you physically receive it or not, you have to plan your taxes such a way that you are going to receive it. And as of March, you have to still disclose it in your return of income and pay your taxes due. Now, at this point, it becomes very crucial for you to understand how can I plan my salary tax. Something that is very common is when you see your pay slip. Now, this pay slip is something that your employer will give you at the start of your employment. He will show you. What you will notice is it will not only have salary, but there'll be various other portions. You'll see allowances, perquisites. Now, this can be quite confusing. Why are these portions there in your pay slip? Why do you think there are so many variables? Because this is a very unique section where salary allows you to plan your taxes. That is, there are certain allowances, certain benefits which, if you avail as a part of your employment, you can take some tax deductions and exemptions on. What are they? Now, some employers will say, listen, you plan your pay slip. This is going to be the amount that is going to be your salary per annum. Say you're going to get 5 lakhs salary per annum. You tell me what components you have. Now, when you're given this option, it is important you exercise it and tune it to how whatever benefits you will have. So, during my course, I'm going to cover some very, very common benefits which will more or less be applicable to all of us, which you should ensure is forming part of your pay slip so that you can avail these benefits. Starting with house rent allowance. Typically, a lot of us are going to be paying rent if we don't own a house. So, for whatever reason, if you own a house in another city and your employment is nothing, you're going to pay rent for it. This comes to our house rent allowance. Now, if house rent allowance forms part of your pay slip, the rent that you pay on a monthly basis, you can claim some deductions up to the criteria allowed in the Act, which is what I've put in the table. If you're living in a metro, you can take least of these three, either 50% of your salary, rent paid minus 10% of your salary, or the allowance you actually pay. The lowest of this, you can, if you give your employer the necessary supportings like your rent deed, proof of payment, then you can avail this deduction. Similar to this, another very common allowance, which we feel is not used by all because you might not be aware, is this leave travel allowance. What does the Act say? The government is encouraging you to go on trips, to take leave for a short period of time, and you can claim that amount as deduction. What it means is, in a block of 4 years, up to two trips within India, if you have the necessary supporting, you can claim this as a deduction. So whatever you're going, save your train tickets, your air tickets, up to two trip in a block of 4 years, you can claim this additional deductions if you give it to your employer correctly. Now, when I say block of 4 years, currently we are in the block of 2018 to 2021. So, in this period of 4 years, if you have made any trips for which you have saved the train ticket or the air ticket, explore this option and avail this benefit. The third common one is called as a special allowance. Now, as a course of employment, your employer might want you to wear a uniform. For that, he would have given you money. Similarly, for you to travel for the purpose of employment, your employer might have given you an allowance. Take your telephone bill. You're a salesperson, you make a lot of phone calls. Now, all these allowances that is purely and fully only for your employment, rendered as a course of your employment, is fully exempt in your hand. Even though your employer is going to give that to you along with your salary, you need not pay tax on these allowances. There are a lot more allowances that the Act gives, but in a smaller amount. It is worthwhile for you to still avail these benefits, because when you take it as a per annum, and if you have two children, up to two children, you can avail this, where it will increase. This is your children education allowance, your hospital expenditure, all of which I have listed. There's one more specific set of allowances which I've listed here. Even though smaller in amount as per value, it is still a beneficial one. What is that? Say you're not able to work from the city because your factories are in distant areas. So, in order to help you, to compensate you for working in a backward area, the government has given many allowances, like your field area allowances, your special compensatory hilly allowance. If you have to work in a hilly area, you get an allowance. So, all these are worthwhile to know. Over and above these allowances, you are also entitled to some deductions. The first one is your entertainment allowance. This is only for the government employees up to an amount of 5,000 rupees. You can claim as a deduction. The next critical one is your standard deduction. What is this? Now, up to 50,000 rupees, irrespective of whether you're incurring it or not, you can take a standard deduction. You do not have to show any proof, nothing for this. You do not have to save any voucher. As at the end of the year, from your salary income, the income tax is blindly giving you a standard deduction. You also have a tax on employment. This is something that your employer will pay on your behalf. You are allowed a deduction up to rupees 2,500. They'll call this as a professional tax also. Over and above these allowances, some allowances become fully taxable. Say, for the purpose of employment, you hail from Bangalore, but you have to move to Chennai. So your employer says, don't worry, I understand your cost will be higher because you have to still maintain your family in Bangalore and you have to relocate to Chennai. So he'll give you something called as a city compensatory allowance. Now this allowance, even though is towards your employment and for the benefit of employment, is going to be fully taxable. Say you're going to a factory, it's in a distant area, you're not able to carry lunch. We are aware that 50 rupees up to two meals per day are allowed for tea, coffee, all those things that are employed, but all that is allowed as an allowance. Now, naturally, your lunch charge is going to be much more, and this you're entering only because your employer wants you to do that. Otherwise, you won't have to incur this cost. Even though you do that, even though it is rendered during your employment, this allowance also becomes fully taxable. Overtime allowance, you work overheads. Because all of this is considered as if it is salary still. It is incurred during your employment, they become fully taxable. Now, we get few questions very often. Say your employer has taken a accident policy. He says, whatever accident you incur during your employment, it is my liability. Because of me, you're incurring that. So I'm going to take a group accident policy for whichever employee is there, for the entire employees I'm going to take. Is this going to be taxable? The answer is no. If your employer takes a group policy, then you do not have to pay tax on it. However, however, if he takes an independent policy, he says, okay, since you are traveling as a course of employment, I'll take for you, but other employees are only going to be in office, so I'm not going to take for them. If so, you still have to pay tax on that. So it's important you know what is being taken by the employer and whether you need to offer it to tax or not. Another common case, some of us are seconded. That is, we work probably from Chennai, but the employer will say, listen, for 6 months, you go to the US, work there, get trained, come back. Now, to move to work in the US for 6 months, they'll give you something called a per day allowance, per diem allowance. Is this going to be taxed? The answer is no. This is a fully exempt one, so you don't have to pay tax on it. The third critical part is something that is newly introduced. Now, so long we've only been paying income tax, but the government is now making it an expense tax also, where they are saying if in the year financial year 1920, that is in the period April 2019 to March 2020, if you have paid electricity bill in a year for more than rupees 1 lakh, or if you have deposited more than 1 crore in your account, or if you have spent more than 2 lakh on foreign travel, not only for yourself but for anybody else during the year from your account, then irrespective of whether you're going to earn income or not, whether you have to compulsorily file your tax return. Now, this is a new clause that has come out. I urge all of you, even though you might not have been paying, you might not have been filing income tax so far, or your parents, please check. The minute any of these clauses become applicable to you, you have to ensure they file their return. Now you may ask, what if I don't file? What if I missed it and I don't file? Now again, since last year, there's been a penalty of between 5,000 rupees to 10,000 rupees for everyone who has not filed their return. So I urge you to understand the changes that are happening. It's becoming very, very dynamic, which is why it's important for you to be abreast of what are these changes and how it is going to be applicable to you. Having said all of that, how do we save tax on the salary? First and foremost, like I said, if your employer is allowing you to structure your salary, where they will say this is your take home, you structure it however you want, ensure that you include this component called as a dearness allowance. Why am I saying this? Basically, if you include dearness allowance in this, your eligibility to take deductions under the house rent allowance or when you're paid gratuity at the time of retirement, to that extent you can claim higher tax deductions in this, because these deductions are computed based on your salary as a percentage of your salary. So when dearness allowance gets included in it, you can take it as a higher amount of deduction. Second critical one is your pension. Now, we have heard of this pension. What is this and how is it going to affect your tax planning? Effectively, pension is something that you will get at your retirement, where employer will give you an option. At the time of resignation or retirement, he will say, tell me what you want to do. Now, you are entitled to 100 rupees of pension. How much do you want to receive today at the time of resignation? How much do you want to receive throughout the rest of your life on a monthly basis? Most of us tend to opt for the second option, where we say you pay me a portion of this every month, so that psychologically, even after completing employment, you're going to get pension in the form of salary. While it is a good thought to have for the purpose of tax planning, try to commute, that is, try to take a lump sum amount as pension and instead invest it in other forms where you will get a monthly return. Why am I saying this? Is because when you get that lump sum commuted pension as a lump sum on the date of resignation, there are tax benefits of one third or half as a deduction which you can claim, which you cannot claim for the monthly pension. The monthly pension that you're going to receive is going to be fully taxed in your hands. So this is an effective tool for planning your salary. You're aware, recognized provident fund. Most of us will have this in our payslip. What you need to remember is this is your saving fund. Whatever provident fund your employer is putting on your behalf is your saving fund, which you can withdraw provided you make a 5 years continuous service. There is an exception to this. Today we are living in very difficult times. Not all of us are getting salary on a monthly basis, so the government has been extremely considerate. What they've said is, in the event you don't have money, go online. You can withdraw your PF, even though you have not finished your 5 years of service. Withdraw this PF, and remember that we are not going to tax you on this. This is an exceptional clause that has come here. So in the event somebody is finding it difficult, you can look into withdrawing this PF. The next point is, generally at the time of retirement or resignation, you're given various other components in your salary, which will be your gratuity, the pension, your PF, so many other components. So when you plan this retirement, try to retire at the beginning of the year. Try to retire at the beginning of the year. Why do I say this? For income tax, when they compute the deductions from gratuity, like say gratuity, you get up to 20 lakhs deduction. Your leave encashment, whatever leave you have accumulated, which you have not taken, you're allowed to encash it. That is also as a 3 lakh limit. All these deductions are computed based on the number of years of service. So if you resign at the beginning of the year, you can take that benefit. Or you resign at the end of the year, then you can take. Say you're resigning in the fourth month, then that 4 months of service will not be considered. Minimum you need to have 6 months. So this is a good planning for you to have. The next is gratuity. Like I already said, sometimes people wish to receive it during the course of employment. Now, gratuity after resigning or retirement is going to be tax free to the extent of 20 lakhs. But if you decide you want to get it during the course of employment, you can still claim this relief under Section 89. This is something you can discuss with your auditor and ensure you're taken a benefit from it. The last being during your course of employment, your employer might give you a telephone, laptop, asset. All these are going to be tax free, but only restricted to these three. Because anything else that you get, say your employer gives you a house for you to live from when you're working, that is going to be taxed. So whether it's going to be monetary or non-monetary, both are going to be taxed apart from the ones that I've said here. So, having understood salary, it forms a major part of your income for those who are employed. So, ensure that you have robust planning for it because every rupee of tax saved is equal to your income earned. So, as important as it is for you to receive that salary on a monthly basis, it's equally or more important for you to save tax on. Now, what have I put on the screen? This is the McDonald's burger. I'm sure all of us have either seen it or we have even gone inside and have had a few fries and burger. Why is this going to be relevant here? Now, typically when McDonald's opened, their USP was they gave you burgers at a very low cost in an extremely speedy manner. Which what does it entail to McDonald's? They have to invest in that machinery to ensure that everything is automated and given to you. And when they sell that burger at a low cost, they're still going to pay the price for the vegetables and everything that goes into the burger. So how are they going to earn profit? How did they become such a big empire today where every corner of the street has a McDonald's around the world? Do you think they earned this profit from that every burger they sold? Do you think they're able to expand so much with that amount? How are they profitable? What they did was they not only kept their money in the burger, where they actually earned money was they bought the land and then they did something called franchising. So where the owner will not sit and run every shop. Anybody who's willing to run a McDonald's has to approach the owner. He will take that land on lease from the owner and he will build his own McDonald's shop and then sell the burgers. So what is the owner getting? He's not only getting profit from this burger, but he's also going to get rent on a monthly basis from the franchisee. Correct? So this rent is what saved McDonald's. It was in the brink of collapse at one point in time where they were making huge losses because they only focus on burger. But the minute they expanded the empire into getting these lease rental from the land that they gave to the franchisee, they started earning huge profits and they became a multi-billionaire empire. Which brings me to the next slide of income from house property. I urge all of you to plan your income from house property. Not only me, the income tax itself is saying this is the only section where they are allowing you to choose options as to what you want to determine under income from house property. Typically, your taxation from house property is going to happen whenever you own a house which you rent it out to somebody or you yourself occupy. As long as there is a building with the land appurtenant there too, you are going to have to pay tax under this head. Supposing, say you don't own a house in a building or any superstructure, it is just going to be a vacant land that you're going to lease. That will not come under this head, but that will go to income from other sources. Now you may ask me, why does it matter? From my end, I'm still going to be paying tax. Why should it matter which head it comes under? Which is where you have to remember. When you come under house property, you have several deductions which you can make use of and plan your taxes, which will not be available under the head income from other sources. When I say house property, it does not typically mean residential house. Even if you give it to a mall owner, restaurant owner, other if you are not using it for your business, as long as you're not using for your business, if you earn rent from it, you still have to pay tax on this. Now, on the screen you see two things. One is self-occupied, one is let out. What is this? What is the difference? Self-occupied means if you buy a house, you yourself with your family move into the house. That means it is self-occupied. You are occupying that house. The other one is let out, where you buy a house, for whatever reason you decide to rent it. That rent you earn from this will come under let out property. The key difference between these two is, in the case of self-occupied, you are not going to have to show any income, correct? Because you're not going to earn any rent from it. So automatically you will only claim the deductions from it. It is highly beneficial. I will cover in more detail as to what the deductions are. If you take a let out property, you are going to be getting rent from it. So naturally, that rent that you get as your income, which hits your bank statement, you have to offer it to tax. Again, for this also there are various deductions. The first deduction being your municipal taxes. Only thing you have to remember is municipal tax deduction, whatever is the actual amount you pay is allowed as long as you actually paid being the owner. If your tenant is paying this for you, you cannot claim a deduction for this. You have to have a proof of payment by the owner in order to claim this. The next significant deduction under let out is a standard deduction. Now the act simplifies this for you. What they say is you expend whatever you might incur brokerage for having someone let out on rent, you might incur commission. You don't take all those deductions because it is very subjective. Instead, I will voluntarily give you 30% deduction. Irrespective of whether you're spending or not, whatever you're doing, you can take a 30% deduction. Very significant deduction because automatically only 70% of your income from house property is going to be offered to tax. This benefit you will not have in a self-occupied property because naturally when you do not get rental income, where is the need to have a further deduction of expense of 30%? It will be an over benefit for you. Which brings me to the most crucial deduction in house property, which is in the form of interest on loan. More or less, many of us would have taken loans, housing loans, in order to either construct a house or buy a house or move into a house. For all these reasons, when we take a loan, the act is saying, I will allow you a further deduction of interest on this loan. How is that going to work? In the event where you are letting out the property, you're letting out your property on rent, whatever interest you pay, you are allowed to take a deduction. In the event where you yourself are occupying the property, they have restricted this deduction to only 2 lakhs. You may ask, why should they do this? I'm still spending. The reason is, in let out property, you are offering the rental income to tax. Correct? You're offering an income, so they're saying you take whatever deduction you want. But in self occupied, income tax center is saying, no, you don't have to offer anything. You just take the deduction. So they've limited this deduction. Please keep in mind, if you're acquiring or constructing, if you're buying or constructing, you can take 2 lakhs. But if you're just doing repair renewal, then you can take only 30,000. So the loan agreement that you draw, please remember to keep in mind you see what the purpose of the loan is before you sign it. Not only that, over and above these deductions, they're also saying the principal amount you will have to repay up to 1,50,000 you take as a deduction under ATC. So principal also they're giving benefit, interest also been giving benefit. Now one step further they've gone. From financial year 1920, the government wants everybody to own a house, to have the feeling of ownership. So to push this affordable housing scheme, they are saying if the stamp value of your house is less than 45 lakhs, over and above all those above section deductions you can take a further deduction of 1,50,000 under section 80 EEA, provided you meet the criteria. So such is the benefit of your house property. Now, having understood this, there is one critical catch point. Earlier I said For let out property, irrespective of the amount of interest, full amount they are allowing as reduction. There is one clause in this. The government said while you can take whatever interest you pay per year, we are going to limit this to 2 lakhs. Supposing you paid 3,50,000 as your interest on the housing loan on a monthly basis, on a yearly basis, what income tax is up to 2 lakhs you take as a deduction. That 1,50,000 you carry forward to the next year. They are not saying you can't take it at all. You can still take it, but the overall limit per year that they're imposing is going to be 2 lakhs as your loss from house property. Having understood all of this, one amazing amendment has come out where for financial year 1920, you can claim up to 2 houses as self occupied. Earlier, they said only one house you can claim. Now, the government is extending that benefit, saying up to 2 houses, even though you don't receive rent, as long as you're occupying both the houses for your own purposes, you can claim a deduction. This is a very, very good clause that has come out. If you are someone who owns 3-4 houses, it is the right time for you to plan your taxes as to what you are going to offer as a self-occupied property and what you're going to offer as let out. Because keep in mind, when you offer something as self-occupied property, you can completely take the benefit of that loss, and you can always set off. Say overall you have two houses which you're going to now choose as self-occupied. That 2 lakh, that benefit that you're going to get, you can always set off against salary. So salary is going to be an income. Say per year you're still going to earn 5 lakhs as salary. You can take this 2 lakhs as a benefit, and only 3 lakhs you have to pay tax on now. So having understood these points, there is one critical clause. Now this clause becomes very, very relevant during the current times of corona, where you have a house property, your tenant is going to occupy that property. For reasons of financial difficulty, he might not be able to pay you the rent, correct? He is still going to be there. Or he's still continuing with the lease, but he's gone back to his hometown. Ideally, ideally, house property is a unique section where taxation on notional rent is there. Where even though your tenant is not physically giving you the rent on a monthly basis, you still have to pay tax on it, except for an exception under this unrealized rent clause, where according to section 25, if the owner is not able to collect the rent, and if he is able to prove all of these points, that is the tenancy should be bona fide, that is there should be an actual rental tenancy agreement, that if you should have tried to vacate your tenant, or the tenant himself has not occupied any other property of yours, and if you've tried all of this, tenant is still there, you have done legal proceedings. However, during these times, you are well aware that the government has said you cannot vacate a tenant just because he's not paid rent. So what will you do? Because under the act, the clause is clear. Only if you satisfy this, you don't have to pay tax on that rent. Otherwise, even if the tenant is not paying you the rent, if you have not taken this step, you still have to pay tax on that. It doesn't matter to us when you're going to receive the rent. What you can do as to plan your taxes, check your original rental agreement. See if there's this clause called force majeure. Force majeure means act of God, where now there are clarifications that are slowly coming out, where they say corona is act of God, you do not anticipate it, so I will invoke this clause. Now, supposing if your rental agreement does not have that clause, then ensure that you enter into a supplementary agreement clearly indicating that because of these times, the overall rent has reduced for that year. If you have this supporting in your hand, then you can always strongly contend and not pay tax on the rent that you have not received. Thereby, you won't suffer that liability. There are some scenarios that are very, very common to house property. First and foremost is going to be a self-occupied property. Like I already said, there's an amendment that is going to happen, that's happening for 31/3/20. So ensure when you file your returns, you're aware of that. Second is, say you own a single house property. For 4 months, you yourself are occupying in it. For the balance, you found a tenant and you have to move cities. So you're collecting rent. For the purpose of the act, it does not matter that you occupy. If a single unit, even for a few months, if you have let out, they consider as if for the full year it has been let out. So there is no question of availing the benefit of a self-occupied property where you can take the rent as nil. Another case, That same house, ground floor you're living, first floor tenant is living. In such a case, for the purpose of income tax, you can take it as two entities where you will offer tax only for the rent paid by the first floor by the tenant, and ground floor you do not pay tax on. Another common question that we have is you collect this deposit, something called as a security deposit. What you need to check is, as per the agreement, if this deposit is going to be refundable by you, then no problem. It is considered as a capital amount that you're receiving for safety. There's going to be no tax on it. But supposing there is no such clause, and whatever security deposit you collect at the beginning, you're not going to refund, then this also you have to pay tax on, because it is considered as if it is a rent received by you. So these are the nitty-gritties that are there in these provisions, which you have to be well aware and plan your taxes accordingly. The last one is with effect from assessment year 1819. For real estate, there is a significant amendment where they have said in some cases the real estate company would have completed the construction, but there might be a delay to get the certificate of completion. Correct? So earlier there were a lot of disputes where they said you have completed construction. That means it's as if you're going to get rent, even though tenant is actually not living there. You have to consider as if you have rented it out, and you have to pay tax on that notional rent. So now they're given a period of 1 year where they say 1 year after construction till you receive the completion certificate, the value of that property will be taken as nil. This is a good amendment that will be used in the industry. Having covered both these sections in detail, let us understand what are the deductions available to you. There are significant deductions provided for individuals and HUF, especially by the Act, where over and above the income that you earn, the government is pushing for you to save money for your future by allowing you deduction on whatever expenditure you have. To the extent which falls under these quota, you can claim a deduction. First one, very, very common, is your ATC, where say you have a public provident fund. Lot of us would have invested in this. Say you paid tuition fee for your children. All of this up to an amount of 1,50,000 you can claim under ATC. Next critical one is your ATCCD, which is your national pension scheme. It is something that is worthwhile exploring for your retirement. This is a very safe scheme for you to invest in, where up to 60% of your corpus that you receive after you retire is exempt. Not only that, every year over and above your ATC, an additional amount of 50,000 is allowed as a deduction on a year-on-year basis if you put into NPS. Third is your ATEE, which is your interest on housing loan, which I've covered in detail. See if that is applicable to you. Then, of course, if you take a Mediclaim insurance, the access not only for yourself but also for your spouse and your parents, up to 50,000 rupees per year, or that premium that you pay, you are allowed a deduction. The last significant deduction that will apply to all of us is Section 80TT, which says whatever interest you get only on your savings, ma'am. A lot of us confuse this to any account. No, only your saving bank account interest that you get up to rupees 10,000, you are allowed a deduction. If you are someone who's over 60 years old, up to rupees 50,000, you are allowed a deduction under 80TTB. So I hope I've covered the important clauses that will cover every individual for you to save taxes. I will now hand it over to Abhishek, who will cover capital gains and some crucial recent amendments that have happened in the area of salary for which you have to benefit from. Thank you so much. Thank you.
A very warm good afternoon to all the listeners. Now that Divya has completed her session, I'll very quickly cover a few important changes on two important topics. First being capital gains, important amendments pertaining to capital gains, and tax planning tips pertaining to capital gains, and the new salary structure. I'm sure you've all seen this in the latest Finance Act during the budget presentation. The Honorable Finance Minister, she had stated that they are coming with a new alternative tax slab structure, So now we have two tax slab structures. Which one will be more beneficial for us? Most people who are watching today's program are salaried persons. So therefore, you'll all be curious to know which scheme should I select. So I will cover that also. Now let me quickly talk about the key tips pertaining to capital gains. Now I'm not going to cover the basics of capital gains due to want of time. I will not go into the basics. Instead, I will straight away start with what are the tax planning tips. I have a house. I'm going to sell this house. I have a house. I'm selling a house. But what is capital gains? When you have something called a capital assets, whatever you gains you get from that house, that is your selling price minus the purchase price that is indexed to the current inflation. Whatever is left is your gains or your profits from selling that house. So this profits is known as capital gains, and this capital gains is taxed at special rates. Now, how can you save the capital gains? How can you tax? It's a very, very peculiar provision in the Income Tax Act where they allow you to save tax and capital gains. Many avenues, so many sections they have given where by law, I am not talking about you very, very intelligently planning. I am saying law itself is saying these sections are there. Please take these sections. You yourself plan the tax. You reduce your tax, reduce your capital gains. So that this is there. Let us understand what these sections are, how we can plan and save your capital gains tax. Now I have a house. I'm selling that house. Now there are various reasons I can sell this house for. I can sell it because I need the funds for some purpose, like my son's education. He's going abroad. He's got into Harvard. So I need to pay for that. So I'm going to sell this house and pay for his education. Or some other personal emergency reason I need that, so I'm selling it. Or it could be as simple as I'm selling this house because my father purchased that house. He was living there. Now he has moved into my house only. He has become old. He has moved into my house. I am taking care of him. That house is going to waste. So I'm going to sell that house. So various reasons are like that, like this. So suppose I'm selling that residential house and I want to purchase a new residential house, then in that case you can enjoy what can be called section 54. What does section 54 say? It says first the asset that is sold must be a residential house. It should not be a land, should not be other capital assets, it should be a residential house. So I'm selling a residential house. It must be a long term capital asset. That means what? For at least 2 years. Earlier, long-term capital asset, you had to hold it for 3 years, 36 months. They have reduced the holding period to 2 years now. So if I hold an asset for capital asset for 2 years, then it becomes a long-term capital asset. So this house that I want to sell, it must be a residential house. It cannot be a commercial property. It should be a residential house. It must be a long-term capital asset. I should have held it for more than 2 years. And what else is the important provision to take the benefit of this? Whatever capital gains I got from selling this house, I must reinvest it in a new residential house. I must buy a new residential house. Now you can ask, when should I buy it, sir? Can I buy infinitely? Because I have to file my return when? Let's assume I've sold my house in February. In February, I have sold my house. Normally, return filing due date is July. I have to file my return by July. Does that mean I have to invest in a new house by July? What the act says is when you're buying a new house, you should reinvest it 1 year before or 2 years after the date in case you are purchasing a house. In case I am constructing a house, I myself am building a house, then they're giving 3 years after the date of sale, 3 years after the date of transfer. I have to complete such construction, or I have to purchase this house within 2 years after that, or 1 year before. But there is one important condition here. What they are saying, the new house should also be a residential house. We already know that. But for 3 years, you should not resell this house. You should not resell this new house that you have purchased with this capital gains. You should not resell it for a period of 3 years. What will happen if I resell it? Then the year that I'm selling it, whatever exemption I took as capital gains in the year that I purchased it, again that will be taxed to me. If you comply with these terms and conditions during the year of sale, you will not have any tax. You can think several lakhs gains I've got, capital gains. Normally, when you're dealing with property, you always talk in lakhs only. So you have earned several lakhs or several crores of capital gains. If you comply with these conditions, you don't have to pay a single rupee of tax if you plan properly. So you can earn several lakhs and pay zero tax. So that is the effect of these provisions that I'm talking to you about now. So therefore, you have to ensure you comply with it correctly, because by mistake, after 2 years I've been living in this new house. I'm like, what new house? I don't like it. I want to get a new house. Another house has come opportunity. I'll sell this house. And you sell it, then what you do, you violate that tax saving provision that you had enjoyed. Therefore, you will be again brought to tax. I'm also dealing with numbers in lakhs, as I told you. So the tax amount also will go into several lakhs. So be very, very careful when you are planning for your capital gains. So this is section 54. Next is section 54 EC. Same thing, almost all the conditions are identical, except here the asset that is sold. In the previous example, what asset you have to sell? You have to sell a residential house. In this provision, what they are saying, any asset you can sell that is long term. So you may ask, can I sell a land? Yes, you can sell a land. Can I sell jewelry? I have jewelry that I'm holding for more than 5 years, 10 years, sometimes 40, 50 years. I'm selling that jewelry. That also you can claim as a long-term capital asset. It is a capital asset. So under this section, you can continue to claim under 54 EC. But what are the provisions here? Capital gains, firstly, you must reinvest it within 6 months from the date of the transfer. From the date I sell it, in 6 months, I have to reinvest it. And reinvest it in what? I have to reinvest it in specified bonds. Government will say, these are the notified bonds for capital gains. So if you want to take that 54 EC benefit, you have to invest in these bonds. They'll make an announcement like that. Currently, there are REC bonds, NHAI bonds, which are called notified bonds. You have to invest in this within 6 months from the date of the transfer. In the earlier example, what did we say? 1 year before the date of sale or 2 years after the date of sale in case of purchase. In case you are constructing, 3 years after the date of sale in the case of the 54, section 54. Under section 54, you see what they are saying? Within 6 months from the date of transfer. Therefore, residential house also you can reinvest in this. Suppose I'm not at all interested in buying a new house. I don't care about new house. I want to put it in a bond. I want to earn some interest on that money. So in that case, you can invest it in a notified bond and you can earn interest out of your savings. But the condition here is that there is a lock-in period. If I invest in these notified bonds, I cannot resell it for a minimum period of 5 years. Earlier it was 3 years. Government extended it now for 5 years. So now your lock-in period is 5 years from the date of acquisition. From the date you purchase this bond, minimum 5 years you have to hold it. There is also an upward ceiling. More than 50 lakhs you cannot reinvest. So if you have a capital gains amount more than 50 lakhs, then in that case you can only up to 50 lakhs you can reinvest here. If you want to reinvest the balance, you have to look at other options or you can pay the tax on this. The final tax planning trip as far as capital gains is concerned, your section 54F. This section 54F and 54, almost word for word, they are almost the same. Two critical differences, only two critical differences. What I will tell. The first one being the asset transferred in 54 was what? It has to be a residential house. Here under 54F, it has to be any asset other than a residential house. So if you sell a residential house, you can take 54, you can take 54 EC, but you cannot take 54F. If you sell a land, if you sell a jewelry, you cannot take 54, but you can take 54 EC, you can take 54F. So that is the distinction as far as 54F is concerned between 54 and 54F. 54 is for residential house. When you sell it, 54F is any asset that is long term other than a residential house. The reinvestment period is the same, 1 year before or 2 years after or 3 years after in case of construction when you buy a new residential house. So the new asset has to be a residential house, and and on the date you purchase this new residential house, you should not own more than one residential house. What does that mean? That means suppose four I have four houses. I am selling one house. that one house that I am selling today, I'm selling that house today, that one house that I am selling today, what will happen? I will go for the benefit of section 54. Can I claim it? Yes. I will go for the benefit of 54 EC. Can I claim it? Yes, you can. I will go for the benefit of 54F. Can I claim it? No. Why? On the date of purchasing a new residential house, you must not own more than one residential house. You are already owning three. You are owning four more before you sold one, but you are still owning three. Therefore, you are disqualified from this section. So that is the key point. The next important key point is while 54 and 54 EC, both these sections, you had to reinvest the capital gains. What did I tell you? Sale consideration minus purchase value, that will give you your capital gains. That profit alone, if you invest, it was enough for 54 and 54 EC. Under 54F, it says you have to invest the entire sale consideration, not just the capital gains. So therefore, I am selling for 100 rupees. I have purchased it at 40 rupees. My capital gains is 60. 54 and 54 EC, what they are saying, you invest that 60, enough, we are happy. What is 54F saying? You have to invest that 100. The full 100 you have to reinvest. So that is the other critical difference between 54F and 54. Now that the key tips as far as capital gains is concerned. Of course, I'm sure many of you are posting in the comments. You can please feel free to ask more questions, because capital gains is a vast topic. Given the want of time, I'm not going into the details of the same. I very quickly touch upon this new alternative scheme that was announced by the Honorable Finance Minister. You see, earlier there was simple three slab structure. Up to 5 lakhs rupees, up to 2 lakh 50 exempt, 2 lakh 50 to 5 lakh 5% tax, 5 lakhs to 10 lakhs 20% tax, 10 lakhs and above 30% tax. That's it. Straight away you had a classification. Then you had senior citizen, means up to 3 lakhs exempt. Very senior citizen, more than 80 years, means up to 5 lakhs is exempt. All these provisions were there. Then the Honorable Finance Minister announced, you see, the Income Tax Act is very complex. There are 150 exemptions and deductions which are there. There are so many provisions in the Act. Several sections, more than 300, 400 sections are there, including subsections, subclause, rules, so many things. So he said, let us simplify it. We'll make it a very, very simple thing. So they came up with a new tax slab structure that you can see on the right hand side. Now the objective of this entire, assignment was simplification. But unfortunately, in the process of simplification, things have become more complicated. Now there is a eight slab structure. You have 0 to 250, 250 to 5, 5 to 7.5, 7.5 to 10, 10 to 12.5, 12.5 to 15, above 15. So you have now a 8-tier slab structure for the taxes. Not only that, what they have done, 70 exemptions they have removed. What did I tell you? There are close to 140 exemptions and deductions there. Now they have removed 70. Which 70? We have to check. Which 70 is applicable to me? We don't know. That also you have to check. Is the old regime better or new regime better? I don't know. We have to check in your case. Okay, I am a senior citizen. For me, new regime I will take. You can, but there is no classification between senior, very senior in the new scheme. The new scheme, whether you're a 30-year-old just to become the peak of your career, you're earning the highest money, and I'm a 90-year-old who's retired, I'm sitting at home, I'm getting interest. There is no distinction. In the eyes of the law, both of you are the same. Both of you are the same. There is no classification as senior citizen, very senior citizen, normal citizen in the new scheme. So under the old scheme, you have so many benefits. You have so many provisions which you could have taken benefit from. They have removed all of that in the new regime. But not only that, it has become a little bit more complex, because just like this, I'm addressing such a large gathering. Can I tell you the new scheme is better? No. Can I tell you old scheme is better? No, because it becomes a person to person thing. So every case has to be evaluated by a professional. It has to be evaluated by a professional. And I can tell you, many of the faculties, in fact, when I was going through the comments, I found that so many people who are here are clients and long-term friends of ours. And for each of them, I will not have a common solution. because the way you plan your taxes, the way you plan your investments, what are your future ambitions, how you want to achieve certain goals, you will have your own financial goals. Based on all of this, your benefits, whether it is old or new, has to still be evaluated on a case to case basis. So unfortunately, in the efforts to simplify the process, I can say that it has become more complex. So this is known as popularly the cobra effect, where you have to you try to find a solution to a problem, and the solution makes the problem even worse. So this is commonly known as a cobra effect. So these are some of the deductions, as I told you. These are commonly used by salaried persons, and none of these deductions you have if you take the new regime. Standard deduction, all of this the previous speaker had covered in detail. Standard deduction of 50,000, leave travel allowance, HRA, professional tax, children education allowance, your interest that you're paying on your housing loan if it's a self-occupied house, your ATC, ATD, ATE, ATG, all of these deductions, none of it you have available under the new scheme. So therefore, now as I told you, you have to evaluate on a person to person basis which scheme is beneficial. But you can take this thumb rule from me, and you can apply it in all of your cases, where if you are currently enjoying exemptions or deductions exceeding rupees 2,50,000, 2,50,000 and above, then straight away you reject the new scheme, you stay with the old regime. It is more beneficial for you. Why we have to discuss this? Because many of you will be getting letters from your employers now saying, please select whether you want to be taxed under the old scheme or the new scheme. You'll be getting a lot of these letters. You have to plan your tax structuring. Many of you may have already got it. If you have not got it during the lockdown period, as soon as you resume normal operations, you will start getting these letters, because they have to deduct their TDS from your salary or from your income based on your decision. So therefore this decision is very critical. My suggestion again is, suppose you are not sure, then definitely go to a professional, get their help, because you have to learn to plan for a long term period using these changes and this new regime or the old regime, whichever is better for you. So I think the other aspects we have largely covered. So why don't we start taking up more questions now, so that we can have more discussions and we can learn more in this process. So thank you very much for giving me this opportunity for addressing it. Why don't we take up some questions now?
Yes, sir.
Shall I take questions from the comments, ma'am?
Yes, sir. Yes, sir. Definitely. It was a really interesting and very nice session. So I think many of them have questions to ask. So you can clarify it, sir.
Sure,
Okay,
sure.
thank you.
I
Thank you.
think if you have any questions, feel free to type it in the comments box. Yeah, we're just quickly scrolling through the comments to see if there's any questions that popped up. If there are two houses, can the husband and wife claim self-occupied house property under Section 24 separately? See, if the criteria is ownership. If you want to claim income from a house property and you want to claim the deduction under Section 24, the primary criteria is ownership. So if you own two houses, and you can claim one house is in the wife's name or one house is the husband's name, or it is co-owners, both are co-owners, then you can claim. But normally the logic, that the restriction is that if there is somebody else who's a close relative of yours who owns a house in the same city, normally they will look into it to see if it is genuine or not.
So, adding to that point, one way you can plan this is, supposing if both of you are earning, then one of you can own each house property. That way, you can also claim benefit under 24 for that house property, and your wife can claim for the other house property. Or you can also choose to co-own. That is, both of you own both the properties. In this case, this is unique to co-ownership. It's a good way for you to plan taxes, where each of the co-owners are allowed to take full amount of deduction of the interest. If you're taking loan, each of you can take separate loan, and whatever interest you pay for that, you can take as a deduction.
As there are
And
no deductions Stays the truth. The changes perceiving. It's not that there are no deductions, Subramania Adiga sir. As I told, it depends on what scheme you are choosing. Whether you want the new scheme or whether you want the old scheme. If you take the new scheme, then you don't have most of the deductions. I won't say not all deductions. There are still very few deductions, but those deductions are not commonly used by people. So, for all practical purposes, let's assume that there are no deductions. So, that way, as I told you, you have to evaluate on a case to case basis. You have a beneficial tax paid, but so many deductions are removed. So, in your case, which is better, old scheme or new scheme, you have to evaluate before you choose it.
I think some of you have already raised questions before, but since the chat was live, we might have missed it. You can feel free to post again so that
Yes,
we don't
many of
miss
the
it.
questions we cannot scroll beyond it. It's extinguished when many new questions come.
So
So,
request you to post them
yes,
again so that we'll be able to answer it.
yes.
Recently announced that PF money return taken for an emergency. So my request how to apply PF and how many
I think
will take to get so how you operate your PF, it's mostly online now, sir. You need to get the UAN number. There is certain activities to it. Just go into your PF portal and you can definitely take your answers for that from the portal itself. So if you want to withdraw all of it, you can do that. It tax on capital gains by directly into the existing.
I think what ma'am is asking is, or what sir is asking is, if we repay the home loan, will it constitute payment for capital gains? No, sir, because whatever you pay towards purchasing that property, that is what is a capital gain. If I have to, I'm purchasing a new house, I'm incurring or I'm redirecting that sale consideration or I'm redirecting the capital gains towards that purchase, that part I can claim.
I've invested in mutual funds taxed in my hand or my wheels.
This is a question of clubbing.
Clubbing,
This is a
yeah.
situation of clubbing where they will check if the funds that been invested in the wife's name, since she's a homemaker, it's unlikely that she has any other source of income. She does not have an independent source of income. Then naturally, the money that she has invested, the income that she is getting is coming only from your hands. So therefore, it will be clubbed with your income. So my suggestion here is there are some tax planning avenues. Maybe you should take it offline and reach out to a professional that they'll be able to guide you in this situation.
We
How
can
you
always put our email ID in the chat box. So whoever wants to reach out to the presentation or other doubts, you can feel
feel
free to do
free.
that.
Yes.
I think the same question we
Sure,
just
okay.
had.
Okay, for the benefit of all, kindly touch upon the cost inflation metric. So I didn't want to go into detail, as I said, due to want of time. Capital gains is such a vast subject; it deserves an entire session by itself. And we will be doing a section on capital gains. I have covered in other forums, but on this channel also. So in case anybody has not subscribed, I request you to please subscribe. I will cover it in depth. But since sir has asked, let me briefly touch upon it. Is that I purchased a property in 1960, or my father purchased a property in 1960. I'm selling it today in 2020, this property. Now, they would have purchased it for what price? It may be 10 acres of land, 20 acres of land, but at that time, they would have purchased it for 200 rupees, 300 rupees. Suddenly, today, that is worth several crores. So, you may think, I'm talking about capital gains, sale consideration several crores, minus purchase consideration 200 rupees. Effectively, the entire profit only I am paying as capital gains. That is where the government has stepped in and they said that we will adjust your cost, we will adjust your purchase price for inflation. So you may have purchased it for 200, but what we will do is we will take a year-on-year inflation and we will see what is the value of the 200 today as per this calculation. So your purchase price will be adjusted; it will be increased for that inflation. That means what will happen? Your taxable profits, your taxable gains will reduce. Therefore, your tax also will reduce. So that is the logic of this inflation index.
As he has to work out tax on the old and new, which is absolutely right. You have to work out at both schemes. It's not one true fit for all solution. It will vary for each individual. So ensure that you work out. If you are someone who has a lot of deductions, like if you have Mediclaim premium, life insurance premium, then old scheme might be more beneficial to you. So case to case basis. With my pencils, can I house rent allowance benefit? So this is another in the event where you have a rental agreement, you're paying monthly rent, you can claim this allowance as a benefit. In the new tax, so the new tax, yeah, you can definitely claim because your accrued interest is going to cover your house property, which I had covered in detail. So you can still avail whatever interest you're paying, so deduction. Yes, we will definitely share our email, Rajendran sir. I think we've just covered this. Yeah.
I think we seem to have covered
Most of the questions. I'll just input email ID here, so you can.
You can always watch back the video again. Also, you can find our email ID and phone number so there. If you need anything.
So we'll hand it back to ma'am.
Yes, we'll get the session. So we are now handing over the session in the able hands of the teachers of Civil College. Over to you, ma'am.
Thank you, sir. I now request Dr. Archana Binju to give the vote of thanks, sir. Archana, ma'am.
Yes, very, yes, ma'am. It's audible.
Yes, yes.
Very warm good evening to one and all. I'm grateful to the God Almighty for bestowing this great occasion to propose vote of thanks. I would like to thank the management for giving us an opportunity to conduct this faculty development program. Extremely grateful to our president, Hiro S. Madhapachettiya sir, and the secretary, Dr. G. Selvanathan sir, for supporting and motivating us to conduct the activity program. My sincere thanks to our principal, Dr. S. Sharma, for the constant support and guidance for this program. I'm very much thankful to our director, Professor Paneer Selvam sir, for enlightening the event and his valuable suggestions. Thankful to the IT coordinator, Ravi Balan sir, for the teamwork extends to conduct this event. Deep sense of gratitude on behalf of Department of Commerce of SIVT College. I profoundly heartfelt thanks to our resource persons, Dr. C. Abhishek Murali sir and C. Divya Abhishek for accepting our invitation and delivering a valuable insight on the topic Epitome of Tax Savings Tips. Sir and ma'am taking the session in very organized manner and sharing their expertise knowledge with us and patiently answered all the questions, bringing more clarity to the topic today. Once again, thank you very much, Abhishek sir and ma'am Divya ma'am for your informative session. And I mentioned my deepest sense of appreciation and could place on record my heartily thanks to Dr. M. Vijayalakshmi, head of the Department of Commerce and convener of this faculty development program. On behalf of faculty of Department of Commerce, we thank you for enriching our knowledge and guiding throughout the year, ma'am. And my hearty thanks to the organizing committee members, Ms. A. Yashoda and Dr. G. Aruselvan sir, for giving their great support in this event. Thank you, sir. Thank you, ma'am. My special thanks to all the faculty members of Department of Commerce for your support. And especially, I thank Professor G. Magesh Kumar sir for his great support. Last but not the least, a very big thanks to each and every participants for the overwhelming response and made this a great success. Thank you, one and all. And one more announcement: dear participants, that is feedback has been posted in the chat box, and I kindly request all the participants to fill it up and submit by this evening before 6 p.m. We assure you we will you will receive the certificates within a week time. Thank you, Ananta.
Thank you so much.